I wanted to work the first exam from 2019. I'm going to use the yellow version. It's version 2. And I hope all of you signed the honor code on the front page. There we go. So here we go. The first problem is quite a bit like the one we did in class and very much like the old exam problems. As usual, you just need to be very careful about dates. So we're going to do the 2018 transactions, and we learned that he billed and collected $100 times 25 customers, and this is times the months, and that equals $30,000. And then this was in December 17, a customer prepaid the services. So the cash flows are only this $30,000 because this $2,800 occurred last year. So the taxable cash basis service income is just the $30,000 we collected. This $2,800 would have been taxable last year when it was received. However, last year when we received it, the general rule for an accrual taxpayer is you pay tax when you earn it. The first exception is if you collect it, pay tax then, but the services have a special exception that if you receive prepaid services that don't go beyond the next year, you can defer it until it's earned. And so this $2,800 prepayment received in 2017 is taxed in 2018. So we have $3,200,800 and $32,800 for GAAP income. Now the interest expense, we've got two different amounts here, a prepayment of $200 and $150 per month, or $1,800. And $1,800 plus $200 is this cash flow of $2,000. But in no circumstance can you deduct prepaid interest. So the deduction for both cash and accrual basis and the GAAP expense is this $1,800. Okay, then we have a lease. There's nothing about a related party here. And the amount we paid this year was $480, paid in 2018. And so that's our deduction. This is just like the practice problem, except in the practice problem, the rent went up, and here we've got a happy taxpayer, the rent had gone down. The accrual expense for both GAAP and tax purposes is $510, and you compute that $510 as 3 months for 2018, so 600 divided by 12 times 3, plus we now have 9 months of 480 divided by 12, and so this sums to $510. And then finally, here you have to be very careful about the years. The client sued him in 2017, that's last year. And so for GAAP, this would have been the 2017 GAAP expense. Now for tax purposes, we can't deduct anything until we paid it. So there's no deduction under either cash or accrual basis because it wasn't paid until 2019. The only tricky part is, what do we do for GAAP income? Now we expensed $8,000 in 2017, but in 2018 we learned that we're only going to owe $7,200, and so that creates GAAP income. This is positive of $800 because our expense was over accrued. And so if you were to sum these up, I know there were no points assigned to that. It was just a convenience for me. If you got those subtotals right, I didn't have to go look at the details. Okay, so also on this page is a net operating loss problem. Let me see if I can make that a little bigger. Yep. And I had both handed this out in class and perhaps done a video of it. We've got an $8 million net operating loss, and the first question is, how much can you deduct in 2019? It is limited to 80% of taxable income, so $800,000 is 80% of this $1 million. Now, this question says, if I'm expecting a 21% future tax rate, what's the deferred tax asset at the end of 2018? That's the year that the loss occurs. Now, a deferred tax asset means a refund that I hope to get later. Deferred means later, and a tax asset is a refund. So if my tax rate is 21% in expectation times my $8 million net operating loss carry forward, the deferred tax asset is $1,680,000. And you would learn in intermediate accounting, it's possible you would have a valuation allowance posted against that if the realizability were not more likely than not. But this was a simpler problem than that. Okay, let's go to the next page. The next page has accrued bonuses, and this has been on the 2017 exam. The law hasn't changed here. And I have bonuses for unrelated parties. And then I have her sister, Sandy. That is a relative. And this is an individual, so Sandy would be a cash basis taxpayer. But the business uses the accrual method. So the answer to number 1 is, and they were paid in January. January 2019 is less than 2.5 months, so deduct $700,000. That's the amount paid for unrelated taxpayers. The amount we deduct in 2019 is Sandy's bonus of $100,000. And I guess the why, well, part of it is this 2.5-month rule. Can't deduct Sandy until she reports the income. And she's a cash basis taxpayer, so that's in 2019. Okay, let's look at the property acquisition problem. Here's one where you had to be a little more careful to make sure you were applying the new law, not the old law. And we have three types of property here. This is an apartment, so this is residential. We have a factory, this is non-residential, realty. And then equipment is personalty. So the first part of the problem is, what's the Section 179 expense? And we can only expense $500,000 because both of these properties are qualifying for the Section 179 expense, and this plus this is $3 million, which is $500,000 above the limit where you can't acquire qualified property more than $2.5 million. So this difference is $500,000, and the Section 179 would be $1 million. And so we lose $500,000 of that. And so this sum is the total $500,000 we can get. So now the question is, which property should we apply to the $500,000 to? Well, you're not allowed to apply it to realty in general, but starting in 2018, you can claim it against non-residential realty improvements, and this is a new roof, so we can claim the $500,000 here. Here you've got the planning choice. I could have put it on either property, but the realty does not qualify for bonus depreciation. So given that we can take bonus on the equipment, we should use this $500,000 against the new roof and claim 0 against the equipment. And now for bonus depreciation, we can write off the entire equipment in this very first year. It's at 100%. Now, I like to do a subtotal right here because that's how much we're going to apply the depreciation tables to. So we'll do $20 million for the apartment. We'll have $900,000 for the new roof and 0 for the equipment. So let me just finish the equipment column because at this point it's easy. There's nothing left to depreciate. My cost recovery in 2018 is $1.6 million, the entire thing. And then in year 5, if I sell it, there's nothing left to depreciate because I already recovered the entire cost. Okay, so now we need to go to the depreciation tables. And for the apartment, this is residential realty acquired in November. So here's residential, here's the 11th month. So in the first year, I would take 0.455%. So 0.455% is $91,000. This roof is non-residential and it was bought in March. So non-residential property bought in March is 2.033%, and 2.033% is $18,297. So My total cost recovery is $91,000 for the apartment, and it's $518,000 for the new roof because it's 18 plus $500,000. Okay, so now I sell all three properties in year 5, and this is the month I sold it in, July or September. So first I go back to residential. The amount that I would do in year 5 is 3.636%. 3.636% times the $20 million times, now we need an adjustment. If I sold it in July, I've held it all the way through June, that's 6.5/12. And 6.5/12 times 3.636% times $20 million is $393,900. I do a similar thing for the non-residential realty sold in year 5. Years 2 through 39 are 2.564% times 900,000 times an adjustment factor. If I sold it in September, I held it all the way through August, that's 8 months, plus half a month for September. And that amount is $16,346. Okay, then we have a property disposition problem, and we did one like it in class, and it was on the prior exam, but we've had a few changes to the law since then. Okay, so this is going to be a corporation, and we're doing year 5. So we sold inventory for 50 minus a basis of 80 is a loss of 30. And this is inventory, so this is an ordinary loss. The investment stock, we sell it for 45 minus a basis of 35. So we have a gain of 10. We sold it in year 5, we bought it in year 5. I have a $10,000 capital loss. It is short term. Then we have stock sold for $100,000 that we bought 3 years ago for $109. I have a loss of 9. This is a long-term capital loss. All right, my basis in the machine is 40. 105 minus 65. I sold it for 120, so I have an $80 gain. Of my $80 gain, the lesser of 80 or 65, my accumulated depreciation, is ordinary income recapture. The remaining 15 retains its 1231 character until we get to the bottom. Now, I sold a warehouse, and I sold it for $4.7 million. The accumulated depreciation is $3,450,000, and so I have a gain of $150,000. Okay, so I have a gain of $1,250,000, and this is a corporation and this is realty. So I recapture 20% times the lesser of accumulated depreciation or the gain. So the smaller number is 750. 20% of 750 is 150,000, and that leaves 1,100,000 to stay in the Section 1231 character. Okay, so now I have an installment sale. I sold it for 600,000. My basis is 500. So my gain is 100. So my gross profit percentage is 1/6 or 16.667%. And if I take that times the $90,000 cash I collected, then I would report 15,000 of long-term capital gain this year, the year I received $90,000. Okay, and then I have a worthless stock loss. The general rule on abandonments is it's ordinary, but if it's worthless securities, it's treated as if it were sold on the last day of the year. That's capital. But if it's an affiliate owned more than 80% or more, it is ordinary again. This is 7%. It's less than 80%. So you are stuck with a $28,000 long-term capital loss. So now we subtotal everything: 185,000, 1,115,000, and $12,000. At this point, this is a gain, so it becomes capital, 1,115,000. And remember, 1231 assets by definition are long-term assets. This is long-term. And so I have 185,000 of ordinary, and I have 1,103,000 of capital, of which, so I'm going to have 185. And if I look up at all of my capital, I only have one short-term asset. That's the $10,000 that's short-term. So of my 1,103,000, 185,000 plus the 10,000, if this were an individual, would be taxed at 37%, and the remaining, which is 1,093,000, would be taxed at 20%, which is the favorable long-term capital gain rate for the highest tax rate individual. You lost a point if you weren't keeping track of the short-term gain. Mostly people did well on this problem because we had practiced it in class. So mostly people did pretty well here. Okay. Here's the one exception that I didn't work into the prior problem because I thought it would be easier to grade as just a discrete problem. If it's helpful, you could keep track of the unrecaptured amount, although I didn't require that or grade it. So, and these would be unrecaptured losses we're keeping track of. So if you have a 1231 gain, it's capital. That's the general rule. And a 1231 loss is ordinary, and at that point I can keep track of it. So now I have a $7,000 gain, and rather than main capital, I'm going to have to treat that as ordinary, and so the unrecaptured amount goes down to 1,000. I have 3,000 now of an ordinary loss, so this goes up to 4,000. And now I have a gain of 10,000. I recapture 4,000 of it. This now goes to 0. So the remaining 6,000 is capital. And the 5th year gain, there's nothing to recapture, so all of it's capital. All right. Related versus unrelated losses. The key thing here is this is an unrelated party. Most of you noticed that. So now we just treat it as separate gains and losses. So Fatima sells land with a basis of 10 for $3,000. And so there's a $7,000 loss, and that's the end of Fatima's Inc.'s transaction. That's it. And nothing, Sandra buys it in year 3, sells it in year 4, so now that's a transaction, it's $10,000. So because they're unrelated, years 3 and 4, there's no overlap between them. Okay, I almost gave everybody full credit here because there was enough red ink bleeding in the rest of the exam. The tax cut, the projections, the short-term projections were for a big sufficiency problem. The efficiency gain, the basic word I was looking for is something about increase investment, which leads to grow the economy. So if you said anything like that, you got credit. And then convenience, everybody got that right, which is less complicated for the taxpayer. So you said something like that, and I gave you credit. All right, that's all of the problems. By my marker, I've used 27 minutes. And I know that's a little quick, but I think almost all the problems on the exam, you had seen multiple examples of them. So if you're thinking about how to approach exams 2 and 3, you want to practice the old problems so that you are comfortable working at a fairly quick pace. Okay, so let's go through the multiple choice. This is a U.S. citizen, and the key thing about U.S. citizens is they are taxed on their worldwide income, whether they live in the U.S. or not. So this is false and this is false because the U.S. government does have jurisdiction to tax, and it's not elective for Mrs. King. She has to file in the U.S. and pay tax. We would have dealt with this a little bit in the chapter that dealt with jurisdiction. So somewhere between chapter 1 or maybe chapter 4. Okay, we have an increase in income tax, and Acme directly reduced its dividend by $100,000. And so this is a question of who bears the incidence, because remember, a corporation, while they are a taxpayer, a corporation is not an individual. So some individual is going to bear the burden. Either they cut the dividend, or they cut wages, or they increase prices to customers, or decrease prices they pay suppliers. In this case, this 100 equals the same 100, and so the shareholders bore the full burden. Okay, I only had one or two students get number 3 right, but I went back and looked at my notes for January 30th, and I really had laid out Congress versus the administrative branch versus the courts. And Congress is the Internal Revenue Code. That's a top high authority. You have the Supreme Court over here, and then you have regulations by the Treasury Department, and then the IRS issues rulings. And so from a chart point of view, this is like the lowest authority compared to things like this. So the correct answer about what carries the least authority is a revenue ruling by the IRS. Okay, with problem 4, it's a 35% tax on his 100,000, and now the tax rate has gone up, and the question is asking what is false. So the false answer right here is what I'm looking for. Yeah, I think it's missing in the key. If he took a second job to maintain his disposable income, this is not the substitution effect. This is the income effect. This would be an example of substitution. Based on a static forecast, they're going to collect 5,000 more. That's true. And if he took a second job to maintain his after-tax disposable income, this is also true. So if he increased his income to, say, $104,000, then G would collect more than $5,000. Okay, most of you got this right. He lives in a state with a 6% sales and use tax. He's already paid 4% of sales tax. And so it asks what's true. So always be careful to see, is it asking about true or false? And it's that he has a use tax liability to the excess 2%. So technically, he would file a return charging him 6%, and he would get a credit for the 4% he's already paid. All right, number 6, a proportionate income tax. That means a flat rate. So not regressive, not progressive, but a flat rate. And if it's a flat rate, your marginal rate does equal your average rate. Again, look, this says what's false. Under a proportionate rate, the taxpayer with the least income pays the same percentage. Yeah, that's true. All right, a theoretical justification for a proportionate rate is better wealth redistribution. This is false. What you would need here is a progressive system. If you tax high-income people more and tax low-income people less, that would be redistribution. So the answer is C. All right. Federal income tax allows individuals with a casualty to reduce their taxable income. This is a horizontal equity issue. We did in class the example of A, B, and C earn 100K, and A has nothing going on, B has medical, and C has many children. And we talked about, should B and C pay less tax than A, because even though they each earn 100, to make it the case that the equity of are people with similar ability to pay tax paying the same tax, you might permit deductions here. Vertical equity is not the answer because vertical is more about, it's about rates and the system. Oh, let me pause that. Okay, 3 more to go. All right. Whoops. Let me give you a minute to look at this question. If it's okay, I'm going to use a printed out spreadsheet for this. We have taxable revenue of $42,000, tax-free revenue of $6,000, and deductions of $20,000. So the before-tax cash flow is the entire sum. So we add up everything to get the before-tax cash flow. But part of the revenue is tax-free. So my taxable income is less than my cash flow by the tax-free revenue. And now we have a 40% tax rate, and that applies to taxable income. Now, after-tax cash flow is before-tax cash flow minus the tax. So the circled numbers. And so 28,000 minus 8,800 is 19,200. 44,500 minus 14,400, etc. is 30,000. To get the present value, well, this was year 0, 1, and 2, so I would have taken this divided by 1.06, and I would have taken this divided by 1.06 divided by 1.06, or you could have used the tables in the back. And then once I add up all these present values, I get 89,976, which is, okay, so there's a little bit of rounding, but that's not a big deal. Okay, now I've got an investment opportunity where they're taxed at different rates. So the 6% investment is tax exempt. So I multiply that by 1 minus 0%, and I still get 6%. The 7.5 is taxed at 1 minus 15%, so I get to keep 85% of it, and that yields 6.375%. And then investment 1, I have to pay tax at 24, so I get to keep 86% of it, and that's 6.84%. So I should invest in investment 1. Okay, and then finally, this last question, remember it's asking what's false. And okay, I want to shift deductions from the low tax to the high tax, so that's true. I want to shift income from high tax to low tax, that's true. And any transaction that accomplishes B or C also needs to not fail the assignment of income doctrine. So the answer is D, none of the above. And so anyway, I appreciate you watching. I hope this was helpful. I'm not going to post a solution to the other versions because they are qualitatively the same, just with different numbers. And as always, I'm hoping this seemed, in hindsight, like a reasonably fair exam, particularly given all of the practice we had done on, oh, I see I missed one here. The last thing is these cost recovery questions. So timber, the answer to get full credit had to give a cost depletion answer and be reasonably specific, because we did talk about it in class. And, you know, it would be trees cut divided by beginning of year trees times beginning basis. So we're recovering it proportionately. Here's where some people lost some points because in 2018, shelving installed in a rental store, personalty equals 100% bonus depreciation. So I know in the 2017 exam you could have just said use makers, but wanted a little more specifics about the when. Inventory, cost of goods sold is FIFO, LIFO, specific ID. Organizational costs of $52,000. Well, you can deduct $5,000 reduced by the excess over $50,000. So the answer would be deduct $3,000 now and $49,000 over 15 years. And then this would be 15-year straight line. All right, I will post this to YouTube and then the link up to Canvas. And you are always welcome in my office. Often after the first midterm, people who don't find my office hours convenient want to see me personally, and I will absolutely make time for you. I really want you to succeed in this class, and I will continue to give you a lot of information in advance of the exams about what the structure of the exam will be. So thanks. See you in class.